Hello friends, my name is Nitish. I'm a co-founder of Startupmitra. If you are an early stage startup or you are a startup person or you are planning to start your own startup, what are the three important criteria you should see before you venturing into your startup journey? In this podcast, we are going to interview Mr. Parag Dhol, who is a venture capitalist and also founder at Athera Venture Partner. So basically this fund helps early stage startups to grow their business. So in this podcast, what we are going to have is basically we are going to see what is the perspective of Mr. Parag Dhol on Indian startup ecosystem and also his perspective on the so-called recession and winter season for startup funding and also his perspective on the future startup ecosystem in India. During this course of time, what I observed is he is one of the well-connected person and well-read person in ecosystem where if you have any doubt or if you want to grow your business, you should connect with Parag Dhol because he brings that much of value and also connection to your startup where it is easy for your startup to scale up to the next level. So friends, I again welcome you all to join me and hear from Mr. Parag Dhol. Thank you. Most of the time what I see is like not investor startup founders, though they have a idea, they come and they say, okay, hey, I'm looking for a fund. So all these questions I keep on getting through an email and all. So we will start the discussion from this point, uh, where I'll be asking a first question. If you are ready, we can start the conversation.
Yes, I am. Shoot.
Okay. Okay. Thank you, Mr. Parag Dhul. Thank you for accepting our invitation and joining this conversation. As a investor who is involving or who was involved in a startup ecosystem for more than, I think, 20 plus years, right? What is your perspective about present startup investment scenario that is happening in India? So if you can express your opinion and also your perspective on this, that will be very helpful.
So I presume when you ask that question, you're not referring to the downturn, etc., but the overall growth in entrepreneurship is what you're referring to, and that is very, very healthy, Nidesh. So what we see, the deal flow has been going up consistently. Now there are specialized funds. For example, SaaS founder will look for people who have done SaaS deals before, for instance. Some deep tech funds are emerging, etc., etc. Deep tech founders are going there. TAI has a deep tech SIG, for instance, just like they had a SaaS SIG, special interest group 5 years ago, etc., etc. So what is happening is the ecosystem in general is from, let's say, the entrepreneurship side, number of entrepreneurs, diversity of entrepreneurship, the support system in terms of, let's say, the legal support that you can get, company secretarial, even hiring, openness to joining startups or funds like us, for instance, or the angel ecosystem. All of this is beginning to come together beautifully. And I think the entrepreneurial activity is here to stay. And the way I look at it, if you look at the US, out of the top 10 market cap companies, 5 of them are technology companies. And we just have to, if you look at the trends of technology and adoption in India as well, we are obviously a much poorer country, but there is no reason to believe why that will not be the case somewhere between 15 to 25 years hence. I don't know a specific year, but that will likely to be the case, and in which case technology entrepreneurship is here to stay, and it's in safe hands. Young people becoming entrepreneurs, but coming at it with energy, with knowledge, etc., etc. So it's a secular growth, and it's very heartening to see.
Okay, so when I asked the first question, you said like we are not focusing on a downturn of the downside of the investment that is happening in the ecosystem. Just wanted to understand your perspective. We see a lot of news article related to the downside that's happening in ecosystem as well as in terms of funding. Can you throw some of your maybe your perspective on that also? Why this downfall startups are seeing?
So see, first thing is venture capital investing, like it or not, is correlated to the economy, stock market, etc., etc. Just that's just how life is. There was easy money available between, let us say, the years 2018 to 2021. Lots of companies got funding. Some of them were good companies, deserved it. Some of them were probably not so, etc., etc., or got more money than they deserved. Whatever. So I think that is just a part and parcel of capitalism, the way I look at it, because capitalism just means that there will be booms, there will be hopefully not complete busts, but there will be down cycles, and we are in one of them. So let's just accept that this is part of us as VCs, part of life as entrepreneurs, and run a tight ship in these times, focus on profitability, focus on unit economics, etc. This is not to say that you should not focus on unit economics when things are good. Good entrepreneur focuses on the right things all the time. That's what defines a good entrepreneur. But on the margin, you can take more risk during boom times and a bit less risk during these times. But the people who took too much risk will obviously fall by the wayside during this, because there will be a cleaning up, and that cleaning up is also part of capitalism, because destruction is also part of capitalism. It's good, actually. Inefficient companies should go out of business. That's just the life. And some of our companies will also probably go out of business because they don't find a fit with the market, or the unit economics do not work out, whatever be that case. So that will happen, but I see those as cycles of 2 to 3 years in length at most. And entrepreneurship, at least even VCs like us, are involved in companies for 7, 8, 9 years. 2 to 3 years is a relatively short period of time in that scheme of things.
Okay, so now just wanted to ask you the basic question, because many of our viewers may not be aware of some technical words that startup ecosystem use. So can you explain us what are the different types of investors are available? Because being a VC, what are the you have gone through this flow also, right? So if you can talk about the different types of investments are available, and also at what level a startup should focus, or startup should approach these investors, that would be very helpful for us.
So see, I mean, I'll try and draw a line from the day that you start, or even before you start, so to speak. I think the first thing is to focus on the product and the customer that you'll have, isn't it? So try and figure out that what you're trying to do is meets a market need that is there. It is a painkiller. It is not a vitamin in that sense. It's not good to have, but it's essential to have, etc., etc. And go out and meet as many potential customers as possible, so that you are not building a product in an AC room, distinct, without feedback loop being completed with the customer. So that is the first point. And now coming to you are past that stage. Let us say you're convinced about what you want to do. You've developed your team, etc., etc. Then maybe you don't have the money yourself. You're 24 years old, 25 years old. You don't have the financial security. Then what kind of funding do you look for? At that point in time, you go out and look for what is known as the friends, family, and fools round. So to speak, these are people who know you, they trust you because of who you are, etc., etc. You raise that 50 lakhs, 1 crore from them, and get started developing the product, and maybe get the first customer out of that money. Then come some angel networks and all of that, Mumbai Angels, Angels, Indian Angel Network. There are many of them, Let's Venture, and various other platforms there. That comes about 6-9 months later, when you maybe have 1 or 2 customers and some initial traction, and you want to raise 2 crores kind of money. At that point in time, you go to that kind of people. Then come the pre-Series A, Series A guys like us, who are at about 18 months into the journey, 24 months into the journey. When you have 5-6 customers, in case of a consumer internet company, maybe you have thousands of customers, but in a enterprise context, you have 4-5 customers, you have initial revenues, let us say 2, 5, 10 lakhs a month, obviously unprofitable, but then you come to a pre-Series A, Series A fund like us and raise that money. And then Series C, Series B, C, etc. follow at 18 months kind of period thereafter. So that's the kind of journey. And it should always start with people who know you, your ex-boss or initially a family uncle, whatever, moneyed uncle, whatever be that case. That's where it starts, and then it gets into more impersonal relationships like Indian Angel Network, or they might not know who Athera is, in the sense that they will not know me from the past, but it is a totally professional relationship. That's when you get into the angel networks and beyond kind of stages. So I hope I outlined that for you.
Yeah. So now, how this venture capital really work actually, and what are the process? And I think there is in venture capital, there is something called LPs and GPs. So if you can throw some of your perspective on this also, that will be very helpful.
Okay. So let me take our example. For example, we are on Fund 3. We run a 369 crore fund, which we have raised from various individuals, family offices, and institutions. These individuals, family offices, and institutions, as I termed them, are called as limited partners, because they are not the partners managing the fund, but they have invested in the fund. People like Samir, Rutvik, and I, my partners at Athera Venture Partners, the 3 of us are known as GPs, general partners, who actually manage this 369 crores on behalf of these family offices, individuals, and institutions. So that is what, and then this 369 crores is going into about 14 companies that we invest in. These are called our portfolio companies, obviously. As and when these portfolio companies exit, for example, Redbus exited for us in Fund 1, we got the money back because the buyer, Naspers in that case, paid us the money, and we returned that good amount of money back to our LPs, so to speak. So that's how it works. You raise a fund every 4-5 years. You raise a fund. We are, for example, going to raise Fund 4. Our Fund 3 is 2018 vintage. October 2018 is when we started investing it. It's coming to towards the end now. We'll go out and raise another vehicle, out of which we'll make another 18-20 investments from that. So it's a rolling cycle for us. And people who invest in the fund are called as LPs. People like us who manage that money are called as GPs, general partners.
Okay, so the final decision makers are GPs, general partners, who actually invest their limited partners money in different stakeholders. Okay, so now
GPs are like, let us say, Prashant Jain, who just quit from what at HDFC Mutual Fund, isn't it? He's investing the money that you and I invest in, let us say, the mutual fund, so to speak. So GPs are like that. Yes, at times some conflict situations arise. For example, we might want to invest in a Fund 2 company out of Fund 3. Then we should go back to the Fund 3 guys and say there might be conflict of interest here, or one of the founders of the company might be distantly related to me, or whatever. Right? If a situation like that, I'm just creating a situation. In that case, we'll go back to our LP advisory board and say, this is the case. These are the mechanisms we are putting in place to show you that it is independent now, but I need your permission to do it. Is this a good thing to do? Occasionally we'll go back to the LPs, but mostly it is the GP decision. Yes.
GPs only. Okay, that's perfect. Okay, does any time you got affected or you influenced this FOMO that is going on in startup ecosystem?
FOMO, fear of missing out. Is that what you're referring to?
Yes.
See, we have been around for a long while. We know that investing is a long, arduous journey, just like entrepreneurship is. Entrepreneurship was not meant to be easy; otherwise, everybody would do it, isn't it? So, it is a very risky journey, lonely journey, more downs than ups, etc., etc. An entrepreneur goes through, let us say, hell at times, and we being one level removed, we also go through that, so to speak. So as long as you've seen those journeys, you are not that affected by fear of missing out. At the end of the day, this is still, and it is beginning to change, it is still capital-starved economy, isn't it? More people are asking for money than there are providers of money. And it is changing as we speak. Obviously, it was very different 5 years ago. It has already changed and will change in future till it balances out, I would assume. But it's still a capital-starved economy. So why would I? And I can't be in each of those 100 unicorns or 105, whatever there are. I don't need to be. I need to be in 1, 2, 3 unicorns in every fund, and I'm doing very well, isn't it? So, so I don't need to run after everything, take every box, etc., etc. Some of the larger funds, because they manage larger money, they need to be in many more unicorns than than we need to be in. So, and given our experience, and I told you the journey is up and down, etc., etc. So we don't suffer too much of from FOMO. It is that is easier said than done, I should say. All of us in a partnership, some might. I am a very much of a contrarian. The others might or might not be to that extent. So it's a balance in the partnership. But I would say overall, our partnership is less FOMO driven than we see if I were to compare us to the average of the market. I would say that for sure.
Okay, that's perfect. I think recently you announced you're launching a fourth fund. I think it's of 900 crores with a cap in that fund actually. And also you have rebranded your fund into Athera Venture Partners actually. So can you take us the journey, what you went through? You were starting from 2008. Where you started and what are the things that has evolved and now where you are standing, including the pros and cons of, or the positive side and negative side of the ecosystem. That will be very interesting to know from your perspective.
Okay. That's a pretty wide-ranging question. Let me try and answer that. Okay, so we got started as a US India fund. Okay, my partner Samir and 2 people in the US, John Doguri and a fairly well-known Indian American, Kanwal Rekhi. They started the firm in 2006, 2007, started raising money, and did a first close in late 2017, November 2017. They did a first close for the first fund. It was a $50 million fund. I came in between the first and the second close, second and final close, which was November of 2008. I came in June of 2008. So the 4 of us in that capacity ran that fund 1, so to speak. We made investments like Red Bus in India, for instance, which was a third investment from the fund, third investment from India as well. So that we managed till 2012. Then we raised Fund 3. Policy Bazaar was the first investment from Fund 3, did very well. Fund 2, sorry. And then we raised Fund 2, again in the US-India structure. And Policy Bazaar, Healthify, Me, Tricog, etc. are companies from that. We made 10 investments in India from Fund 1. We made 12 in Fund 2. And then we decided to restructure the firm. It was a US-India firm. We decided to restructure it, and we called ourselves Inventus India. Our ex-partners, called themselves Inventors Silicon Valley, raised 2 independent funds. Ours was a 369 crore fund, Fund 3. It was raised as an alternative investment fund, etc., etc. I should clarify that we continued to manage Fund 1 and Fund 2 together. All the remaining investments like Policy Bazaar, which listed and all of that, that continued in the normal course of things. But Fund 3 was raised independently and invested independently, so to speak. And now, because we had restructured, etc., we wanted a very Indian identity, isn't it? Because this was a fund out of India, meant for Indian entrepreneurs. So the best way to go about it is choose a very Indian name, and Athera, which means path or direction, is the name we chose in Sanskrit. And that is what we chose. And the idea is to walk that path, that tough path that I talked about, alongside our entrepreneurs. They do most of the tough walking. Hopefully, we help them in that process somewhat. So that is the idea why we rebranded, etc., etc. Now, coming to the other part of your question that you said, the advantages and the pitfalls, etc., over a period of time. So I think something that I said earlier, we have seen the ecosystem grow, in the sense that if you go back to let us say our early days, it was very flavor of software services, so to speak, isn't it? When I was doing venture capital in let us say very early in my career, 1993 onwards, it was mainly software services, some flavors of it, somebody doing tools on top, somebody doing a slight product company, etc., etc. But that started changing. Product companies started coming in with Make My Trip and others starting off. Those were the early days, Make My Trip, Trip Yatra, etc., etc. And then came Redbus and others. So as our Fund 1 came along, that product culture started to happen, and then SaaS happened, so to speak. Subsequently, deep tech has happened now, and fintech, etc., alongside, isn't it? So it has been a good, nice curve in terms of breadth of entrepreneurship, the diversity of entrepreneurship, as well as the depth of it, because now there are many people who are willing to jump into entrepreneurship, and many employees willing to work for startups as well, unlike large companies earlier, typically large companies earlier. So the pitfalls that I would say, today, at least one pitfall from our side that we see is that if I look back 5 years back, most of our co-investors and us thought similarly when we were on a board, etc. Now with so many investors all over, some of whom have full cycle experience, some of whom don't, some of whom come with a certain set of biases. All of us come with biases, isn't it? So because of our experience in life, etc., etc. It's not to say they are not as smart as us, or we are smarter than them, or the other way around. It is just that there is a diverse bunch of people coming in to the ecosystem. And one of the flip sides, I think, is a bit of conflict situations happen as a consequence when they are on the board, which was very rare five years back, because most of the time we thought similarly. In fact, we could almost echo each other's thoughts in terms of the ecosystem, because we knew each other, small VC ecosystem. Now that is beginning to change, and that creates a bit of conflict. See, we are all, each of us can take a bit of conflict, but if there is conflict within investors, it affects the founder and the company very badly. And that's the piece that I at times feel slightly, that is the flip side of the ecosystem growing, if you will, that this diversity of thoughts, which is in general good, but if that comes along with very extreme opinions at times, then it becomes difficult. Or there are a few people who, because they write checks and they think that they are God, isn't it? Then that kind of crowd you find, at a point in time, maybe I was like that, but I got over that fairly early in my career. So those kind of people you come into contact with, and it becomes.
Is it because of the own bias they carry, or is it because the ego that the person carries when he writes the check? What is that actually? What is that triggering point here?
So at the end of the day, the person who writes the check has an unequal part in the relationship, isn't it? What is the leverage in the relationship, at least at that initial point in time? And if the entrepreneur becomes a unicorn, that leverage changes very fast. But at least when you're writing the check, etc., it's a lopsided, and I don't mean it in an offensive way. I just mean it in a very practical this way. That some people have ego, some people are immature, some people are inexperienced. All of those combinations of those, and do not have enough respect for the entrepreneur, whatever be that case. Those are not good places to be for any of us. Definitely not for the founding team. So that's the point I was making.
Okay, so that's very perfect. So in that case, suppose if investor wants to invest, LP want to invest, generally as a general partner or venture capital firm, you do the due diligence, and you also calculate, your analyst will perform all the, they will analyze the company, and they'll come with the reports and all. So still there are, does this bias plays when it comes to investing? Because when the reports are presented, so that also talks to the numbers, right? So this is the future growth of the companies, or all those things are presented in the report. But still, investors bias comes in between, and that takes a center theme while discussion going on.
Obviously, it does. Obviously, it does. I should say that we early stage investors don't have too much numbers to see, isn't it? Because the company is 18 months old. How much numbers does it have in the first place? Revenues are paltry, isn't it? So to that extent, it's not an Excel exercise. It's basically envisioning the future. You're backing the founders. You take a view on the market. You speak with people upstream, downstream. You speak with experts, etc., and form a view of the future, and that's how you invest mostly. So while we prepare an investment memo, etc., it's not 100-page. The business is not predictable at that point in time. Let's put it that way. So how much analysis can you do on it? So is the question. So that's where we are. But what was the crux of your question? Could you repeat that again? Sorry, I got it.
When the investors are presented with the numbers, basically the reports and all, still the ego of the person take the center of the stage while investing.
Okay, more than ego, I think your question was probably biases, and biases are inherent in human beings. So let us say in a particular health tech segment, we have burnt our fingers. For example, a company supplying to hospitals, or a company providing software to schools. You will see us being, because we have burnt our fingers, or we have realized that these are hard models to go after. Another company doing an entirely different kind of software, selling to schools or selling to hospitals, as the case may be, might find a lukewarm reception from us, because of the reason that we have had a bias in the past, for instance. Some of us,
that means your past experience comes actually.
Yes. That is that can be good, and that can be bad, as you know. Good in terms of avoiding mistakes, and bad in terms of missing out on a change in direction that happened in the meantime, isn't it? The market could have grown, etc. If you look at ed tech before, let us say, the pandemic, there was nothing much that was happening, isn't it? But thanks to the pandemic, and no thanks to the pandemic, but EdTech as a consequence became established. It is getting into some challenges again as people are returning, but nevertheless, some of these things could change. So you could lose out on these opportunities because of the biases. Biases could come in various other forms as well. Many of the entrepreneurs today accuse people like us of saying that you only fund IIT or an IT type of people, equal, that's not fair, give everybody a chance. So there are various kinds of biases that come in. Some of us will not fund hardware, for instance. So some of us will not do deep tech, etc., etc.
Yeah.
So there are those inherent biases, because some of these firms like Sequoia and various other, just taking a name, might have some biases they carry from the US, for instance. So we'll not do hardware. I'm not saying that about Sequoia in particular. I'm just saying that you could have, for example, in our team itself, the US team was very, no disrespect to them, but they were very biased against hardware, so to speak. So we did very little hardware during that time, but we have done some hardware in hardware plus software, I should say, in Fund 3.
Okay, that's perfect. Suppose, like, what is the funding philosophy of Athera now? Like, what do you look at when a startup, or what do you look in startup actually before you invest?
So as I explained, Nitish, at the beginning, it's numbers. There's not too many numbers. So you are essentially relying, and the biggest call for us is the founders, honestly. So are these a smart set of folks? Have they been together? Will they stick through thick and thin? Do they know what they're talking about in terms of, are they, if the market doesn't respond, do they have both the intellectual capacity as well as the hustle to move their product around a bit, so that they can target a slightly different segment of the market, etc., etc. That ability to adapt, ability to pivot, all of those. So team is the primary consideration. Okay. I would place more than a 50% weightage on the team, I would say. The second consideration is on the market, and which is where I said some of these biases might come in. You're selling to schools? No, you're out. Okay. Fintech, there might be an opportunity in payments, but what do you do beyond payments? So all of those things that you have learned thanks to your experience, you bring in there, and you take a view of the market, how fast it is growing, etc., etc. How large it is first, and how fast it is growing.
Fast it is. Okay. Scalability. Yeah. Okay.
And the third, so what is it unique that these guys bring to the table? I mean, is it a combination skills? Is it a radically different channel that they have discovered? Is it a technology that is going to, or is it just that Flipkart, for instance, just the initial customer satisfaction in terms of delivering in 2 days when they said 2 days, isn't it? That itself was a surprise during those times. And now you don't think like that, but that itself could be a differentiator, isn't it? Or they did SEO very well, which is another differentiator. So it could be any of those differentiators, so those are the three key things: team, the market, and the differentiators.
So I think I can summarize in terms of very abbreviating this one. So T for time, T for team, and the next one is the last one. What you said is the unique proposition.
USP.
So USP. So TTS is what you look actually.
No, team market, team market, and
market. Yeah, team. So team. Then your total available market, and what is the uniqueness you bring it on the table. So that's wonderful.
So you meant TAM. Okay, fair. Yes. So yes, market is TAM, which is fine.
Market is TAM. Yeah. Okay. What are the segment you generally look into? Because now there are many segments are opening up. Innovations are taking place in various segments. So what are your core segments you look when it comes to investing?
So we have defined ourselves as a horizontal technology firm. Okay, so think about consumer internet, software as a service, deep tech as it is known, fintech, ed tech, those kind of areas. So where technology is front and center to the application. We are almost agnostic to the application. It could be in education, it could be in enterprise, it could be in financial, it could be in retail. So we are not sector we are not governing ourselves by the sector. We are saying technology has to be front and center of our investments. So that's what we do. So we do not bring a very sectoral focus into this thing. We do not say that, okay, deep tech is where we'll put all our money. No, deep tech will form part of the company. If we find a Pixel, for instance, which is a space tech company, I don't know whether you heard of it or not, but great bunch of guys, very young, doing a satellite in space to do something called hyperspectral imaging, which has very significant applications. So and they're extraordinary bunch of folks in terms of both IQ as well as business understanding, business maturity. So we will do things like that. So flexible to the extent of application, but yes, technology has to be key.
So suppose a startup. You also consider technology as a main factors in main aspects when it comes to investing. Okay, so that's perfect. So now, since in the previous discussion you spoke about the edutech sector and what happened to that sector during the lockdown time and all. So there are some, as per my observation, there are sectors like education, fintech, and health tech that got affected positively during lockdown time. But once the lockdown is taken up, right? So immediately they started, most of the companies, edutech, fintech, and healthcare, they started seeing the low or downturn actually. So is it because the time was very perfect during that time and now the time is not relevant for these kind of startups, or what is your view actually?
See, edutech, each of these is a portmanteau, isn't it? It is a combination to it's education technology. So now the thing is, which one is more important? Okay, is education more important, technology more important? So, if, for example, you are appearing for the JEE, NET, or whatever you are appearing for, and you are a consumer who are focused on the best teacher, then it doesn't really matter whether you're doing it on Zoom or you're doing it on, you'll go face to face, okay? So to that extent, you look for the best teacher. Education wins in that situation. And then maybe Akash could win, or one of those guys could win, isn't it? Alan or whatever, Alan and Bajus are fighting there, I think. So let's take that example. Not that I have anything against one or the other, but in that case, Alan might win out. Whereas if you're optimizing, if you're a person who's optimizing for, I don't want to be on the road, or I don't want to go to Kota and study, then you might be willing to do it in a online mode. Now, thing was that obviously online got a big boost when nobody could go out, nobody could send their kids to Kota in those 2 years, isn't it? For instance, so, or whatever college, even in Bangalore or whatever, Alan, or Akash, where whatever you have, etc., etc. So now, obviously, that got a boost. Now that things are opening up, how many people are returning versus this thing? And as it happens, looks like a lot of people seem to prefer face to face. So it's a very hard one in my view. We have also suffered as a consequence. Let me take one example of a company which suffered a lot, but it's coming back nicely, beautifully now. We had a company called Move in Sync, which had a technology solution for transportation. Think about companies like Amazon, Wipro, Infosys, top 50 IT and ITS companies in India. All their transportation needs for that segment of the population which were given cars from office, etc., clubbed together, 2-3 of you come together in a car. It was a way to increase the number of people inside a car to make it more efficient, as well as reduce the number of dry kilometers, which is the car is running without an adequate number of people being in it, isn't it? So it was providing that efficiency. Now, what happened in let's say April of 2021 at 20, nobody is coming to office.
Nobody.
So
Yeah,
almost nobody, except so 100 people coming to office, that number dropped to 5. That number is back to 37, 38 when I looked at the last this thing. And maybe even those 37, 38 are not really attending office all 30 days of the week or 20 to 22 days. So some of these behaviors, how many people now at Infosys, for instance, will actually go back to office 5 days a week like they used to go to? It's a hard call now. Even today, it is a hard call, I would say. So the behavior changed during the pandemic and after, and it was very hard to predict what was going to be the normal. In an economic cycle, you can predict because there is an economic cycle every 5 years, 10 years, isn't it? That is fairly predictable. But this pandemic was a 1 in 100-year event. So people would have made mistakes. We have made mistakes. We have taken a few calls which we shouldn't have. And in retrospect, it's easy to say in retrospect. So, it was harder to predict what would happen after opening up of the economy, thanks to what happened during the pandemic, because of the peculiar behavior of people during the pandemic when you're constrained. That's the point.
Okay, have you invested in any edutech companies in your portfolio? Any such companies?
So we had a company. We had a company called Funtoot, which got sold to Imbibe, which is part of Reliance Jio, I guess, now. So that was our first tech investment. We have made 2 investments from, we have made 2 tech investments from our Fund 3. So those are early stage companies, early to call at this point in time. So that's where we are.
Okay. Just wanted to ask you, because now if you see the edutech companies like Byju's or any Vedant and all those things, they are pivoting. When I say pivoting, earlier they had only online presence. Now they are thinking of going hybrid to meet the requirements of the student. So education is supposed, when I being a person in academic life, I feel a student is my perspective. I feel the interaction between student and teacher will happen more in say offline mode rather than online mode, and that's the best way to share the knowledge. But in online mode, that is not going to take place because of so many things, maybe technological issues or communication issues. Many problems are there. So now, suppose you get what do you mean by edutech company for you? Is it only online, or what do you see when you invest? Because you recently invested and that you got exited from that company also. Suppose you get another opportunity, a pitch from edutech company. What exactly do you see, and you try to invest in that company?
So for us, I think doing a hybrid is something that we would find somewhat difficult to do because we consider ourselves as a technology fund. What do we know about the offline market, etc., etc.? So those we'll find hard to do. Having said that, if I take you to a slightly different sector, but still multi-channel kind of a business, take Lenskart, for instance, isn't it? Started off online, has done a very good job of setting up physical this thing as well. So, so maybe the reality is that a few of these companies will do well. There was Zivame and others which tried before that online, and then this thing, maybe they didn't succeed as much, but Lenskart has done a good job, or a Paper Fry or whatever, and there are a few other names, Urban Ladder included, so I can't really predict, but I would say, see, my thoughts, at least somewhat answer to a somewhat different question on edutech, but nevertheless, for whatever it is worth. When the MOOCs came along, the massively online open courses, massively open online courses or whatever, they came along. My understanding of that, my take on those were, those top 5 students, top 5% of the students, isn't it, who are very driven, who will do things on their own. I think that is the segment that will get served by the MOOCs, in my mind. And Clayton Christensen was a business guru and all of that. He of Harvard Business School, he said, pray for Harvard. And I think that is right. The Harvard, the IITs, etc. In my mind, those kind of schools where the type of top 5% go, who don't need too much of push. They could possibly be doing 10 different courses in the year from Coursera or wherever, and getting a degree, if you will, without a defined MIT or a defined Stanford 10 years later. That could happen. But that 95%, as we have seen in all our classmates, etc., we might be some of the better ones because we were driven or whatever, but 95% of the people, their parents had to push them to come to school, whatever, and lots of push is required, isn't it? When the colleges, that's just human, the bell curve nature of humans, isn't it? So there is only a small portion to that right of the curve, 2 sigma or whatever on the right. So I think that is the situation, and as a consequence, I think a lot of people do need to go physically. It's also, there's a social element to that as well, which you were probably referring to, because when you get to meet with your friends, which is a social interaction plus a learning interaction, because when you're doing problems together, you do it faster, you do it better and all of that, because everybody's thought process is different and they can guide you in a particular direction where the brain improves by working together. So some of those advantages are there. So I personally think that is for the middle and the lower portion of society, of that educational pyramid in terms of capabilities, if you will, or drive, capability plus drive, I should say. I think the middle and this one will go towards the offline mode, and the top might just stick to online. I don't know. I don't know that. Who knows for sure?
Okay. Suppose what if you get a pitch deck from an edutech company which try to solve the problems that are faced by this middle and the lower segment, what we say 95% of the population. So would you be interested to invest, or you just say pass it on?
Unless and until, I mean, see, as I said, my bias here is I'm negatively biased. Obviously, the founders, if they have an approach which takes care of my negative bias, which I believe takes into account my negative bias, the reason for my negative bias, I should say, and solves for it, then I'll be willing to look at it. So we don't, I mean, having said we have negative biases doesn't mean that we will not make exceptions. We'll make exceptions because for extraordinary entrepreneurs or extraordinary approaches, you do make exceptions even to your biases, isn't it?
Okay. So throughout the conversation, I was able to, or I could sense from the discussion, like you are pro-entrepreneur oriented investors, like you focus more on entrepreneur and his team rather than the concept itself or the idea itself. So is it because you believe in the person who is heading the organization, or you believe in the team, or is it because you have some experience now you are moved from showing or focusing on interest towards idea to a person oriented? So I want to know more about this actually.
No, so I wouldn't say it is 100% team. I said 50% plus. I didn't say 100%. Okay. So there is a component to the, I mean, see, at the end of the day, I think Warren Buffett said this beautifully, between the reputation of a management for excellence and a reputation of a business for pure economics, it is the reputation of the business that stays intact, isn't it? So, yes. So you shouldn't be tackling a problem which has poor economics in it. So that is the case. So we wouldn't fund even a set of very bright, driven very classy team going after what we think is a poor economics business. That we wouldn't do. But having said that, a team is the most important thing. Team is the most important thing for us. And I think they say, I learned very early in venture capital, they say, there's this saying which an A-class team can make something out of a B-class plan, but a B-class team can't make something out of a A-class plan. So that I think in general is very good advice, very good advice. So we stick to that for sure.
We stick to that. Okay, that's wonderful. Yeah. Okay, now what is that startup founder should take care before they approach investors, say early stage investors? Yeah, we discussed about you were discussing about the team, the TAM, and uniqueness. Apart from this, what else one should look or one should focus before they approach any investors?
No, so see, the thing is, you have to have a solid, crisp pitch for this thing, which catches attention. Okay, that elevator pitch, as people call it, in 30 seconds, describe.
Sorry to cut you here. Can you tell me about what do you mean by elevator pitch? Because most of the audience may not be knowing what do you mean by pitch. Okay. What do you mean by elevator pitch as well?
Okay, so an elevator pitch is a 30-second pitch about the business. Typically means that if you're going with somebody in an elevator, which is a 30-second ride, typically, you can describe your business to him or her in that elevator, during that elevator ride itself. So you have to get it down to that 30 seconds. So as I like to say, as a teacher's son, my father was professor, if you can't explain, you haven't understood. Okay, so you have to be able, howsoever complex your business, you might be doing the top end stuff in semiconductors, for example. Okay, but you have to be able to explain to somebody what is so unique about you in very simple language in those 30 seconds. So start with that. And it takes work. It takes a lot of work to synthesize it down to 30 seconds. So focus on that. And that first impression is the last impression, as they say. So make sure you rehearse your opening, let us say 20 to 30 sentences over and over again till you have it packed down, so that you're able to convey a message of where you're coming from, touching on each of the aspects that I talked about in those 20 sentences, but be very sure about that pitch. Don't make basic mistakes like say, I have no competitors. There's no business with no competitors. And find substitutes, for instance. Or I'll target 1% of the market. Who's interested in a company that targets 1% of the market? Find a niche for yourself. Define the market in such a way that you have at least 10 to 15%. Otherwise, the company will not be well regarded on the stock exchange or when somebody buys it, isn't it? So basically, people are buying you for market share most of the time, and they at times buy you for technology also. So let me not get that wrong, but majority of the times they're buying you for the revenues that you have, market share that you have. So those are the mistakes you should not make. But the principal thing I would say is storytelling is very important. Try and build in your personal experience. If you felt it, or somebody well known to you. It might not be an absolutely personal experience, but you could have seen it in a business context, and then build it from there. This is what I face. This is the problem that I think is a big problem. This is the way I'll solve it, and this is why I'm unique in the way that I'm going to solve it. So some of these basic questions, if you can get into those first 15-20 sentences, it is, I would say, very good. Keep it crisp. Perfect. Keep it crisp.
Okay, crisp, and also storytelling is very important aspect here when it comes to pitching. Okay, so that's wonderful to know. Okay, what are the key KPIs one entrepreneur should know before they pitch in front of investors? What are they supposed to show to the investors?
So KPIs depend on the type of business that you're evaluating. SaaS, obviously, month-on-month growth, for instance, your churn, for instance, or CAC, LTV, all of those metrics become important. Some of these also translate on the consumer internet side as well. So those are the kind of metrics that people are looking for, and it's. See, a smart entrepreneur, and this is very important for an entrepreneur on an ongoing basis, is discovers those 5 metrics that are absolutely important to track, isn't it? There's too much of data generally that people have, but those 5 things that matter is about a business you should know even when you are woken up at 2 a.m. in the morning, isn't it? So those are the 5 metrics that people are looking for. Find those 5 metrics, and this is distinct from a investor conversation. If you want to run a good business, you have to know those. You have to be driven in terms of metrics, and you have to know those 5 metrics at the top of your head all the time, because that enables you to keep track of your functions, for instance, isn't it? So those 5 metrics, develop those, and 5 is just a woolly number. It could be 4, it could be 6, it could be 8, but it can't be 20 is my point. So because then you lose track. So it is those metrics, that is key metrics, that are very, very important. Develop them for running your business, for keeping track of your business, for knowing your business on a daily basis, and that's what you convey to. It just happens that you convey the same metrics to the investors. It's not as if the investors are looking for something specific which you don't already track. You will know them in any case.
Okay, so calculating ARR and MRR is is it a must for a entrepreneur? So annual rate of return and monthly rate of return.
When I meant revenue, in case of a SaaS company in particular, that translates into ARR and MRR, or MRR/ARR, whichever. I mean, one is multiplied by 12.
Is it only for SaaS company, or is it important for any startup or any business? Because
any subscription kind of business, any business which pays in months, so to speak, which doesn't pay a license fee upfront. A license fee business you would not measure on a. But let's say even a non-technology, tech business, supposedly like Airtel, how would let's say Mr. Sunil Mittal be measuring that business? He would be measuring it. Okay, you've sold so many connections at an average price of 190 rupees, or whatever be that case, isn't it? So that's how he's measuring it. Last month you sold 3 million, this month you sold 3.5, you're doing well, or the other way around, isn't it? Or the 199 rupees dropped to 185, you're doing poorly. So it doesn't matter. In an annuity business, you measure it that way. Those are the MRR, ARR metrics.
Okay, that's wonderful to know. So let's talk about the general trend in the market. Do you see recession is going to affect us very soon? Because most of the countries or most of the reports in media, they are talking about recession, that we are undergoing a lot of recession. All these things are there, and completely negative for me, actually. So do you think, as an investor, do you think that's going to affect us?
So see, the thing is, I always tell my entrepreneurs and tell myself that I can't control a recession. Jerome Powell controls recession more than probably Mr. Das controls here, because that's how integrated the world has become, and this is a supply chain led inflation, isn't it? So to that extent, I guess it is happening everywhere across the world simultaneously. So to that extent, I think what can any of us control? Okay.
Yes.
So focus on the controllables, and controllables you already know. Okay, is your team too big? Are you spread out too thin, etc., etc.? Are you investing enough in the product, or are you over investing in the product? You should cut it, etc., etc. So those are the controllables, and focus on those controllables. These economic up cycles, down cycles will come and go, and there are self-correcting mechanisms also, isn't it? When a recession or this kind of a time happens, then then that crazy price that you were paying for the technology folks just 3 months ago, 6 months ago, that is also not happening, is it? Competition is lower, you have more time, the customer is willing to listen to you. Might take longer to decide, but he's at least willing to listen to you because there are not that many people, competitors pitching at the same time, isn't it? So all of those benefits are there. So good companies are made during recessions, are made during boom times as well. Some of the best companies have actually come out of recession. So to that extent, and I have no crystal glass. I'm not saying there is going to be a recession or not going to be a recession. I don't know. But the point is, even if you were to know, what would you do? That is the point. You can only control the controllables. That's an uncontrollable. Macroeconomics is largely an uncontrollable. Focus on your business, and you should be doing that.
Okay, I think recently Y Combinator and Sequoia Capital, throughout their world presence, actually, they issued a note to all their portfolio companies to control, like they caution their startup portfolios, actually. So what is your view on this, actually? Are they, this, like for me, this is a kind of, they are sensing a recession is going to come and that is going to affect the world. So what is your view on this, actually?
No, so see, I don't know. I'm not a great fan of these notes. These are storied VC firms, and Y Combinator obviously is a very storied this thing accelerator. So there's anything I say on them doesn't affect them a bit because they have classy reputations. But my point is, I'm not a great fan of these notes for the simple reason that nobody knows 100% whether a recession will come or not. Even the best of macroeconomists do not know. I think once, I guess, this guy, one of the famous economists, forgetting the name, he said the stock market has predicted 9 of the last 5 recessions, isn't it? So there is obviously a guess element involved in that, or you are reading I mean, even Jerome Powell till last November said that inflation was transitory. If he can't do it, I would suspect Sequoia Capital can't either, with due respect. So nobody knows 100%. The advice there, I would say, is applicable to all times, isn't it? You should be careful with your money. Capital is important. Make it go as far as it can. You should not throw away money by marketing it at the edge, etc., etc. Use your marketing dollars carefully. Choose your customers. Focus on your customers. Engage your customers, etc., etc. So that is timeless advice in my mind. What if you were to just read the advice in any of those and leave out the section about recession coming, that advice would be timeless. It is irrespective of recessions or booms. You should follow that advice. You as an entrepreneur, as a careful entrepreneur whose job it is to cut risks in your business till the point that increases your chances of success, isn't it? You should be following that advice almost irrespective of the economic environment, is my point. So that's why I said I'm not a terrible fan of those notes from somewhere, because nobody knows for sure, first. And second, the advice is always timeless. The advice is almost, I mean, if you read those notes, you'll figure it out.
More of like they're talking about reduce your burnout so that your bottom line will be, it can be improved. In that sense, they've written. Okay, now coming back to this, the burnout aspect of capital, like many, like we have seen many startups or many companies who raise fund, they are they're burning their capital to acquire clients, actually, or the customers. What is your view on this? Because to acquire one customer, they are ready to burn up to 10,000, 15,000 also. So what is your view, or what is your maybe kind of thoughts that you would like to tell them or tell future entrepreneurs what they should look actually when it comes to acquiring clients and reducing their burnout?
So see, at the end of the day, every entrepreneur is doing a long-term value to CAC calculation, the customer acquisition cost calculation. So he's saying if he's paying 200 rupees for a customer or 10,000 rupees in your example, he's trying to figure out whether he can make 1,000 rupees in the first case and about 50,000 rupees in the other case from that customer for it to be justifiable, isn't it? So so that's the constant calculation that is happening, and the calculation, while you can do it on an Excel sheet, you can say he'll come back to me 4 times, and the product is cost 12,500 rupees, so I'll make 50,000. My gross margin is 30%, and if I subtract all other costs, I'll still end up making 10% margin, 20% margin. But the point is, will he come back 4 times? Will he come back 8 times? Will he come back twice? All of that is first assumptions. Slowly it starts, some of those assumptions start becoming real numbers, till you have a stage like, let us say, Netflix today, where it is very predictable, isn't it? If I acquire a customer, he will stay for 36 months or whatever, I'll make so much money, so I can pay only so much to acquire the customer. Netflix has gotten to that stage, a subscription business. Not necessarily a technology business, but you can still increase the value of a Netflix through the content that you produce, and they produce beautiful content, as we know, isn't it? They're taking away mind share even from TV, for instance. So that is, and now, depending on the proclivity of the entrepreneur, depending on how much risk he can take, depending on how much money he has in his bag, etc., he might be willing to pay. Instead of 200 rupees in my smaller example, he might be willing to pay 300, or a more conservative guy would only pay 100, isn't it? And keep that funnel small. And some people are generally more ambitious than the others. They want to target the market before somebody else comes in, or might have a superior product. Somebody might have good SEO, not requiring you to throw money on Google or whatever. Or could develop a channel, independent channel, could have very great content which brings in people, etc. An academy started that way, because of his YouTube channel, etc. So you could have various ways of either overestimating LTV or overpaying for CAC, etc., which could get you in trouble, or the other way around, as the case may be. But that is the mental calculations which are going on, which gets refined as the and which gets adjusted depending on the amount of money you have in your bank as well. So it is a constant iterative loop between all of this. And I don't know whether that can be machine learned, because it is very, very specific to that particular company. But the point is, it is a completely iterative loop that people go through. Some people will not make it out of that loop because simply it doesn't add up in some cases. I mean, Uber today, after all of this time, is not profitable. So you imagine, I mean, how many iterative loops they have been through. So they'll probably choose their markets. They might even say, I don't know, but I'm just saying, they might say India, the average order value in terms of one customer paying at the most 150 to 200 bucks for a ride, which is $3, it's $2 to $3 in their case, is not worth it. Let's just stick to San Francisco. I'm just making it up, but that's the point. The point is that people then adjust their models, their mental models, to fit certain target segments, or adjust their offerings in such a way that they can get a higher average realization, or average order value, as they call it, AOV, out of the same customer, ACV in the case of average contract value in case of a SaaS customer. So people keep on making adjustments as they go along. In some cases, those adjustments will make the business sustainable. In some cases, it won't. And in some cases, obviously, it was just such an extraordinary business that it was always on the right track, isn't it? Atlassian and others, for instance. So,
recently, like a couple of startups went for IPO. And though they they listed their share for a particular price, and after some time, once it got listed, there's a huge market correction we expected. So my question is whether VCs basically whether they create a hype when they invest in startups to get more valuation, and when the startups come for the actual market where the retail investors are there, the correction take place. What is your view on this actually? Yeah, I know it's a very controversial question, but just wanted to know your perspective.
See, as it happens, one of our companies we back, Policy Bazaar, is in that list and has some of those characteristics. So, somewhat difficult question to answer. But I think I look at it this way. I think Warren Buffett says it best. He says, in the short term, the market is a voting machine. Supply and demand determine it. But in the long term, it is a weighing machine. So if Policy Bazaar is a good, sound, fundamental company, should you be paying 500 rupees for it, 600 rupees for it, or 700 rupees? Should not matter, isn't it? If the business is so sound that it will be 10 years later 5,000 rupees, it doesn't really matter what price you pay at this point in time. So these businesses, all of these businesses that have gotten listed are growing much faster than the rest of the market. That is the case. Otherwise, they can't justify their losses in the first place, because the only justification for each of these loss-making companies, and Nykaa is probably the only one which is not loss-making, is the fact that they are growing faster than the market. So, so the point is that some of these businesses could be very valuable businesses subsequently, and the only change that has happened is earlier companies used to go public, even for us, let us say, InfoEdge, for instance, or a Just Dial, went public after they were profitable, isn't it?
Yes.
Just Dial did quite well initially, but now the model has seen probably a correction set in and all of that. InfoEdge continues to do well, isn't it? Because it went from strength to strength, plus it made very smart investments as well. So, to that extent, the market, this is the first time that the market has really seen companies which are growing very fast and are unprofitable list on it. So it is too early in my mind to judge. We will know in 5 years whether some of these companies actually make it or not. And because of, and each of these companies is sitting on a lot of cash. So they have the they have the flexibility to burn cash for some more time and grow the business, and eventually every business, the cost line and the revenue line has to match. Otherwise it's not a business, isn't it? It is a vanity game. So that if that doesn't happen, then obviously all bets are off for that company. But I think this is a good experiment. 5 years later, we'll know. The answer will come 5 years later. Too early to say at this point in time. But those are riskier stocks by nature, simply because they grow faster, but they are not as predictable as the others, and they don't make money at this point in time. So will that continue forever or not? Nobody has a full answer definitely for all the companies. Maybe for individual companies they do, but they. That's where I stand on it. So, but the short of it is that it is. I think they have been listed for too little time to pass a final judgment. I think the final judgment will come anywhere between 2 and 5 years.
So there are some startups who listed. Even I think LIC also is in a kind of it's in a kind of a state where they are not able to predict what is going to happen, because it's like so much of volatility is happening in market. That's one. When it comes to startup investment or startups, there are two approaches generally startups follow: either to bootstrap or to go for funding. So what is your view on a startup, whether they should go for a bootstrap? Because the classic example what I like to take here is Zoho and Zerodha. It's a multi-billion company now, right? They went completely bootstrap and still they are growing. But still, in other hand, there are many companies who got funded and they're also growing. So what is your view on this actually? What should startup founder should take a stand, and what should investor take a stand when it comes to bootstrap and investment orientation?
I think Sridhar Vembu says it best. It depends on the personal aspirations of the people. Okay, how fast you want to grow. Do you want to lose control? Do you see, at the end of the day, when you take some money from somebody, you are giving up a bit of control. None of us are control freaks, but there is an element of control. There are strings attached to any money that you raise, isn't it?
Yeah.
Even public money that you raise means a lot of hassle at the very least. Quarterly reporting, speaking to analysts, all of that, and answering questions. So every money of any color comes with strings attached. If you are the kind of person for whom, Sridhar Vembu says that for me, profits was not the most important thing. Contributions to society was more important than anything. So I didn't want to be driven by that. Okay, and he's created a beautiful company, just like Nitin Kamath has. So
yes,
in certain businesses, it is possible to create a company like that and grow it to the extent that both of these gentlemen have grown it, and it is admirable to do. Very few people do that. And the second thing is, some of these businesses, let's take Policy Bazaar in our case, it is there was a lot of capital investment in the form of TV ads that was required to establish awareness and the brand. So you cannot do that without a lot of capital upfront, or you will take a very long time to get to where Policy Bazaar has. So to that extent, I think it is a mix. The answer comes from the personal comfort of the entrepreneur. Is he willing? Is he or she willing to give up a bit of control in the pursuit of faster growth, which could come because of that money, or the long-term goals in Sridhar Vembu's case are quite different from let us say, just a profit motive, in which case it is so combination of those. Look at yourself, analyze yourself. Are you like Sridhar Vembu, or are you like one of those more typical people who raise money and go on to and take a decision accordingly? There's no right or wrong. You could go either way. But I will say that there are certain businesses where you can't just build a business like that. A Swiggy can't be built, or a Zomato can't be built, or a Ola cannot be built without initial upfront investments. That's just the reality. They are, as they call, build and they'll come kind of businesses. You have to offer a certain base of service first for people to come. Marketplace businesses are very hard to do in that sense. But Nitin and Sridhar Vembu, all respect for them for sure. So.
That's wonderful to know. Yeah, coming to the last question of this podcast, Mr. Parag. So what is your, can you share your perspective about how entrepreneur, like students, especially from the student point of view, because they are the future entrepreneurs of this country. How should they prepare for themselves actually?
Yes, so understand yourself first. Not everybody needs or should be an entrepreneur in the first place. At the end of the day, each of our companies employs anywhere between 30 to 100 or 200 people, isn't it? So it's not to say that the 30 minus 1, which is 29 people, are not good people, isn't it? There's one entrepreneur, 3 entrepreneurs, subtract 3, but 27 people also work for that company, take a lot of risk and work hard and all of that. So it's there is no I would say the number of employees or the number of other kind of people have to be a multiple of the entrepreneur base. So not everybody can be one. Don't put that pressure on yourself. If you can't take risks, if you're not the kind who are a born leader, you are a introvert, etc., etc. I have some founders who have come to the realization that they are control freaks. They can't let go and they can't delegate. So they would rather keep their team sizes small, etc., etc. So if you're those kind of people, or entrepreneur I backed many years in the past, has the right background, etc., etc., but was never willing to let go of his control of his business, a very Lala mentality in that sense, if I could put it that way. So analyze yourself first on those lines and decide to take the plunge or otherwise subsequently. I would say get some experience under your belt. I think that is helpful. That is really helpful, because because then you see a wider range of problems in society as a consequence of working somewhere, and it gives you an approach. I mean, it gives you a perspective into how business works and all of that. So take that X number of years to develop the confidence, get the idea, get a bunch of connections, etc., and then start something after some thought, after some deep thought. That would be my tested way. But there is no one right answer here. There are we have funded Pixel, which is a bunch of guys who started at BITS Pilani when they were in the third year, isn't it? So and they're doing quite well. So to that extent, there's no one right answer, but having some financial security and some time to develop your ideas is a good thing. But student wise, what helps is these bonds that you develop with friends, because then you get to know, because when you stay with somebody for 3-4 years in a hostel, etc., you get to know his or her temperament and how closely aligned your basic value systems are, and can they go through ups and downs. It's much easier to go through ups and downs. Hari of Big Basket once said a very beautiful thing about his team. He said that, see, the other 3 guys I knew for such a long time that I didn't need to look, even he's the CEO of the company, I didn't need to look over their shoulders. If Vipul was running operations, for instance, I knew he would do a good job. I didn't need to look over my shoulder. So I could take care of investor management, raising money, or interfacing with FMCG companies, whatever be those roles, while Vipul took care of the rest of the stuff, or Sudhakar took care of technology, etc., So that is one key thing that it is always good to that's where teams come along in some senses. The initial parts of those co-founders are basically people you either worked with or have gone to college with, isn't it? And those are the 2 places where you see people for considerable lengths of time, and you have a chance to observe how they react to crisis, and whether your value systems match, and all of those things. And those are and not only value systems match, are there complementary skills, or you are just a replica of each other, which is not helpful in any case, isn't it? So give yourself time, but if you are one of those driven ones and have an excellent idea, there's nothing to say that you can't raise. Today there are funds being raised who are focusing just on student entrepreneurs. The market is mature to an extent. So if you're one of those, please, the Avas and Kshitij of Pixel then you should go to those funds and raise those monies. Or there are many horizontal funds like us who would be willing to back an extraordinary team for sure.
I think Government of India also is pushing this entrepreneurship in the school levels. Actually, they have something called Atal Tinkering Lab, where they try to encourage students to come with a lot of innovative ideas. Though the focus is more on innovation, later they also try to help a student to turn this innovation into kind of commercial product kind of stuff. So that's a really good move. But one should not dilute the focus on business when he start, actually. So when I say dilution, instead of focusing on serving customers, there are many startup founders I have seen. They focus on raising funds only, but they just ignore customers' proposition also. So I think that's very important for an entrepreneur.
I look at entrepreneurship as let us say a solar system. Obviously, the entrepreneur is the sun. Okay, and the greatest planet, Jupiter, heaviest planet, let's take it that way, is the customer. VC is one of the smaller planets, I would say. So focus on
the backbone.
So 97% of the mass or whatever is the sun in the solar system, but Jupiter comes next. So you have to focus on your customer first. You can't be focusing on a small Mercury or whatever be that planet. That's the wrong way to go. Well, that's unmathematical in my mind. So that's the way I look at things. Okay.
Wow. Okay. So it was very nice talking to you, Mr. Parag. I think I personally learned a lot about the ecosystem and your perspective, and even you have given your perspective about, say, recession or a downturn in startups and all. So it's very I'm very grateful for you to sharing these insights. I really thank you, and I hope to see you in our next series of podcast where we are going. We may go in depth about the investment itself on a very sector specific, where we'll discuss about more about the startup in that area. So I once again thank you for spending your valuable time with me.
Thanks for inviting me.
Yeah.
Hello, guys. So, how was the podcast? I personally enjoyed this podcast and discussing with Mr. Parag Dhol, and I also hope that you also do the same thing. So, during this podcast, I learned so many things, and in that, especially my focus was on what are the three important things that startup founder should focus on before he or she start their venture. That is team, TAM, and uniqueness. So I think these are the three important criteria, or these are the founding step for any startup to start, and from that it grows actually, because this is the foundation for any startups to grow. So from this point of view, I really enjoyed the startup, and also I learned so many things from Parag Dhol about the recession and the so-called winter season for startup funding. So there is no dearth for startup funding. Only now the investors are very cautious, and also they will fund only those startups which has these three elements, that is team, time, and uniqueness. So if you are a startup founder, you can connect with Mr. Parag, and I'll be sharing his joining link or his link in the below. And I request you to share your feedback in the comment section. And also, please subscribe to our channel and share this podcast link in your network so that we can reach more people using your support. Thank you.